Did not say in its monthly minutes is Ivory Johnson from Delancey Wealth Management. He joins us now from Washington, D.C. Ivory, welcome back to Arise Xchange.
Thank you.
All right, so walk us through what the Fed basically said today and whether there were any surprises, and there are rarely any surprises when the Fed talks.
No, there weren't any surprises. They essentially said that we're in a transitory state with respect to the economy. There's not a significant amount of growth, and they decided not to raise rates in June. I don't think it came as a surprise to anybody.
Do they believe, as far as we could tell, that the slowdown in growth is cyclical, or is it more secular right now, that we're in for a prolonged, difficult environment?
Well, they're always very careful with their language. And so they tended to think that it was a short-term transitory impact. As a consequence, the dollar was strong in the first quarter. You had the West Coast ports where they had the union issues over there. And so there was also a lot of severe weather. So that may have slowed the economy down. I think it was up, the growth was up 0.2% versus 2.2%, I want to say, in the fourth quarter of 2014. So they do think this is a temporary issue. But my sense is that this is more of a prolonged period that we're in right now.
Yeah, some analysts were starting to throw around the R word, the recession word. Do you think that there's some thinking over at the Fed that might actually take place? Because the first quarter GDP may end up negative, and we may get a negative second quarter reading.
We could. You know, the German bund yields went back up, and so that's what caused the dollar to drop a little bit and oil sort of recover. I think it's a short-term retracement. I think you'll see those reversed in this quarter. But if they were to raise rates, I'm not so much concerned about the recession. It's more the deflation. When companies can't raise prices, that impacts their margin, and so they're less likely to open up a new plant. The wage growth gets impacted. So they're more concerned about, I think, deflation, particularly with raising rates, increasing the value of the dollar. That hurts exports as well.
Yeah, and we see no inflation really out there. And then you look at Europe at what's going on. I imagine that there's some concern that there may be some Europe contagion now hitting the U.S. as Europe slows down a little bit.
Well, you do have very low CPI numbers. Actually, it's a negative in a couple of countries in Europe, and as I mentioned, you had negative yields in the bund. But it's not just the Draghi that's implementing quantitative easing, which is deflating the euro. You have the People's Bank of China injecting a tremendous amount of money into their economy. Not only that, but there's also Japan. So when you have the yen and the euro going down at the same time, that tends to make the dollar a little bit stronger.
The Fed obviously wants to keep interest rates where they are right now. The bond market is telling them something different, though. And we've had guests on the show who say that this could get away from the Fed, that we could see a rising interest rate environment and the Fed really not being able to do anything. And is that a concern for them and for the investors right now?
Yeah, well, that's obviously a concern, that the interest rates, aren't impacted by the Fed as much as they are the bond vigilantes. My sense,
I like that, bond vigilantes.
But my sense is that's not going to happen. I think that you had the issues with Greece. You saw the German bund yields go up, and that there's a counter move with the treasuries. But I think that longer-term bonds, particularly treasuries, will be fine throughout the rest of the year. I don't think that rates are going to go up. It's just right now what you're looking at is not just the United States, but really there's deflation, trending towards deflation. If you look at a rate of change basis throughout the global economy.
I agree. If we do hit deflation and interest rates are effectively at zero, the Fed is out of ammunition, isn't it?
They are. And really the bigger problem I think the Fed was looking at is if they were to raise rates, all businesses are a function of future cash flow. And so when interest rates go up, the present value of that future cash flow declines. And, with companies essentially spending 95% of their profit buying back stock, if they were to raise rates, you start to see a real big pullback in the market. They probably should have raised rates in the fourth quarter of 2013 when the economy was still growing at a good clip. That's not the case anymore, so they're sort of in a pickle at this point.
Ivory Johnson, the founder of Delancey Wealth Management from Washington, D.C. Thank you.
Thank you.
Coming up, two continents lead the way on global economic growth. We'll tell you which two when Arise Xchange comes back. Stay with us.